I'm absolutely blessed, my friend. Blessed and highly favored.
Awesome, man. Awesome. We got lots to cover today, so I'm going to jump right into it. We've got nominations happening in the Senate. We've got interest rate decisions made by the Fed. A whole bunch of stuff is happening. So, this is the show. If you are an investor, if you're either currently investing in real estate or if you're exploring investing in real estate, this is the show for you. We break down all of the headlines and how they can possibly affect investments for you for this year and beyond. So, welcome to the Opportunity Zone. I'm Nate Armstrong, co-host today, and we're going to dive into it. Chris, before we dive into it, would you bless us with just a word for everybody?
Absolutely. Heavenly Father, first and foremost, I'd love to acknowledge who you are and what you are in my life. I thank you for being present in everything that we do. Please bless us and the people that are viewing this so that we can incite just a little wisdom that we've gained through our years of experience so that they can go out and have the life that you truly intended for them. I pray this in your name. Amen.
Amen. Thank you, sir. Thank you.
Absolutely.
All right, let's jump into it. So I want to start off today, kind of down a path. I'm going to show those of you that are looking for an investment opportunity. I'm going to preview one really quick right now, and then we're going straight into the headlines. Okay, you probably heard the big T word a lot lately: tariffs. Actually, the president doubled down on them. They were there, and then they were getting paused, and now they came back in full force. 25% here, 25% there, and it's going to cause a lot of panic for people. And that panic, what it's done for one particular investment that we decided to invest in going on about 2 years now, is the industrial real estate class. For industrial real estate, especially manufacturing, what's happened is every time they say the word tariff, it forces US based manufacturers to think about manufacturing at home because they don't want to pay the 25% tax to get it made somewhere else and then import it. So consequently, our industrial assets have benefited tremendously from this. We have an industrial fund. There's only a handful of spots left in it. If you would like to explore that industrial fund, it pays somewhere between 8 and 10%, either on interest payments or dividend payments, depending on how you come into the deal, between 8 and 10%. And then there's backside profits that get shared with investors that are in that deal. If you'd like to explore what that looks like, we have this beautiful little blog that was written by the team, and it encapsulates exactly what's happening. I'm going to put it up on the screen for you guys. It shows what's happening in that space right now. And I'll get a copy of this out to you if you want a copy of this, but use the link in the chat to sign up with our team, and we'll get a copy of this. We'll get a copy of the prospectus or the offering memorandum over to you on it. It's open to accredited investors. It's paying between 8 and 10%. Between whether you get a dividend or an interest check, there's options for both, and there's profit on the backside. That's our industrial asset. What I'm going to do next, though, is I'm going to move straight in and start hitting the headlines. Okay. So, Chris, I'm going to pull you in for this. We've got, we had the Super Bowl.
Yep.
Super Bowl. I know you broadcast in all the ships worldwide. So maybe you watched part of the game, maybe you didn't. You're a busy guy, but what do you think? Did your team
Well,
win?
I got to tell you that my wife is a huge football fan. I'm kind of burnt out on sports because of my business and my career with dealing with broadcasts and all of that stuff. And I walked in and I started watching the first quarter, and halfway through the second quarter, I looked at my wife and said, I didn't know they allowed high school teams to play in the Super Bowl. It
It
was
was
rough,
that
man.
flat, huh?
I gotta tell you. Listen, I gotta tell you, and I don't mean to offend any Bird fans out there. Mahomes is a good guy. I wanted him to get that three play, and I really wanted him just for no other reason than he's a blessed man who has a lot of positive effect in the world, and I was just hoping I wanted to see his dreams come true for no other reason than that.
He'll be back next
He
year.
will, no doubt,
He'll be back.
no
Yeah.
doubt.
So I didn't watch the game. I spy on the Super Bowl for a different reason, and I can do it thankfully through replays. I like to watch the first three commercials. They're always
Oh,
the ones that have a little marketing hook, little angle to them. So I watch replays the next day, Monday morning.
nice. Well, you know, my other company's in one of those commercials.
Which really?
Yeah, if you look at the MSC commercial, we're on the MSC cruise ships. The video that's up in the background, you can see my logo up on the screens in the sports bar
No,
behind what's her name? Poison Ivy. I can't remember her real name. Um
no
oh, I can't
kidding.
remember her name. Yeah, no, seriously. Yep,
Ah.
that's all
Hey,
us.
Chris, before we get into this headline, like what we're covering next, it's important for a lot of people. We're talking about basically the state of the affairs for multifamily investing. Before we get into that, though, just tell us a little bit about your other company. What do you do? Why are you
Um,
credible?
why am I credible? Because I work hard. I worship. I'm God-fearing, and I always try to do the right thing. That's what makes me credible. What God has blessed me with the ability to do is in my other business, we supply television to cruise ships all over the world. So if you're on a cruise ship and you're watching TV, it's because my other company that I'm exiting from is currently does that. And we supply you with video everywhere in the world. And if you're a friend of mine and you happen to be on a cruise ship somewhere in the world during the commercials on ESPN, sometimes your face may pop up on the television screen. But yeah, that's what we do. And you know, I'm a serial entrepreneur. I've had many multi-million dollar and eight-figure exits of businesses I started from scratch. I'm one of those guys that has a bad attitude when it comes to employment, so I make a terrible employee. So I go out and do my own thing, and I have been blessed with the ability to do that by God, and it's allowed me to affect a lot of people's lives in a positive way, and that for me is a dream come true.
It's beautiful, man. It's beautiful. It's funny that you're a bad employee, Chris, because everybody that works on the team seems to love you. So you must be
Thank
doing
you.
something right.
No, thank you.
So let's get into some of the news and how this is affecting our investors. So big headlines right now is that there's still people moving, not for the same reasons that they did during the pandemic, but instead for your favorite topic, the three-letter T word, tax.
Mhm.
So the data's in right now. We can see all the moves that are happening around the country. I'd like to know from folks that are watching this either from your office or from home. Tell me in the chat or the comment section if you're following us online, what state do you think benefited the most? And what state do you think got hurt the most with people moving to flee taxes? Let me know in the comment section. Chris, I won't put up the answer quite yet, but what do you think? What was the big winner? What was the big loser?
I believe the big loser was California, right? Because once you could work from home, boom, everybody ran from California. Biggest winner. I'm gonna have to go with either. uh, it's got to be Florida. No, I'm gonna say Texas.
Ooh, that's that's in the running. In the running.
Okay.
Let's let's see our comments too. So Texas was a guess from Hassan. Douglas guessed Texas as the winner. And we got Sue thinks a lot of people moved to Arizona. California was a loser, says Doug.
I believe that.
Dan says Florida's the winner. Okay. Here's the official tally, at least according to census.gov. South Carolina was the biggest winner. Now, the
Uh,
states that were mentioned, you guys were all right. They're in the top 5 or so. But South Carolina was the big winner. So tax was a big driver for this, low tax rates. Another top 5 contender that didn't get mentioned, but it's one that we
oh
started taking
yeah.
some in, is Tennessee.
Oh yeah. I moved to Tennessee because there was no taxes.
You didn't say, Chris.
Yeah, I forgot all about that. Yeah.
Yeah. So we ended up acquiring an asset here last year. We got really blessed. The seller bought this asset for 5.7. We paid 3.3 for the same asset 2 years after the seller bought it. So we got a massive discount, but a big play for us is because it's a landlord-friendly state and the taxes are very favorable to us and to our investors. So Tennessee. Big losers. I saw California come up in the chat. California's top 5. I'll hold
Really?
off on number 1 in a second, but Illinois also top 5, big loser. And Dan guessed New York. That's in the top 5. The biggest
Wow.
one of all though was Hawaii.
That makes
Hawaii.
sense.
it's not paradise after all, I guess. Well, those taxes. If you guys want to play with the graph, this is on taxfoundation.org, and you can kind of move it around visually. You can see if it's a red on this color graph, that means they had a large outbound migration. And if it's a blue or a dark blue, they had a big inward migration. So Florida and Texas, yes, they had inward migration overall, but the biggest winner of all was South Carolina.
That makes sense. Temperate climate, good tax rates. Yeah. And
Yeah.
and I don't know if you're aware of it, people that live in North and South Carolina that are originally from New York, they call halfbacks because they moved to Florida and then they move halfway back to New York.
What?
They call it
That's a real
halfback.
thing?
Honest to goodness, it's a real thing. I own a home in North Carolina on the border, and it's true story. Yeah, halfbacks.
Wow.
And I'm
Halfbacks.
considered one of those because I'm originally from Rhode Island, moved to Florida, and now I have a home in North Carolina.
Well, speaking of halfbacks, our next topic of the day is Scott Turner. I don't know that he was a halfback. He might have been, I don't even know what position he was actually.
I don't remember
He was
either.
a football player, NFL retired, and Scott got confirmed as the HUD secretary, real estate developer. He's got a pretty big agenda in front of him. During his inauguration, or rather before inauguration, he was getting grilled by both the Senate and the House on what kind of leader he would be and what he stood for. And they were tossing things at him like, what about the changes in the environment, climate change? What about all of the homelessness that's happening in this country? What about the lack of affordable housing? And in my opinion, this guy handled them like a champ.
Yes.
He leaned into it, did a nice job answering. What are your thoughts on Scott? Is this good or bad for us as investors, Chris?
So allow me please to answer that question where there are times in my life where I can respect people and disagree with them at the same time. His upbringing and his heart is beautiful. I think that one of the reasons that he was grilled so terribly for his confirmation was because he's an outsider that the Good Old Boy Network doesn't want involved because he comes from, different upbringing than most of these folks. I just hope he doesn't lean too far towards communism and I don't know how else, or socialism. I don't know how else to say that. If he keeps, he's a spiritual guy. If he keeps his eyes towards the heaven, and if he helps people up instead of handing out, or helps people out instead of giving them handouts, I think that his agenda will fly. From what I've read thus far, that's the path he's on. I hope he doesn't vary from it. And I hope he doesn't pander to his constituents or pander to anybody and just sticks by what he believes is right.
Chris, I agree with you, but I think that I don't think he will pander unless he totally. There's one answer that he gave, and this is the writer downer. They said, "Hey, what are your thoughts on expanding the HUD voucher program, Section 8 AK?"
Yeah.
And he said, well, I need to evaluate that, but more importantly, we need to have a work requirement attached to these housing vouchers.
I love that.
When I heard that, I did a touchdown dance in my mind.
Yeah, yeah, exactly.
Because that's good for society. Like instead of just, I read another yesterday that was showing the number of families that have now split. Like we used to have 2-parent families, mom and dad. And when they introduced the HUD voucher system 70 years ago, there's a direct correlation to the number of vouchers they hand out to the families that split. So think about this for a second. I'm not trying to go political on everybody here, but just watch. HUD voucher system comes into be and it enables parents to be solo and not together. And in a lot of regards, we saw a family split when the HUD voucher system expanded. And I'm all for bringing family back together. So I hope Scott stays true to what you just described. I hope he stands strong on it. And I hope he brings people to a work requirement of some kind.
I'm all for that. Work and drug testing. If you're taking my money, I think there should be some requirements.
Yeah. All right, let's get into some of the data, Chris. So we've got a lot of multifamily data that's kind of hot off the press coming down the pipe for people right now. Multifamily markets are obviously adjusting. You've got a big lender meeting this afternoon. Tell me a little bit about what's happening interest rate wise, and then just market as a whole, just your perception of what's going on.
Whoa, a lot. So the insane thing is that interest rates haven't pulled back, right? And we can get into that whole conversation of the standoff between the Fed and the current president. We can get into that whole conversation again, but that's a long-winded conversation. So interest rates haven't pulled back, and demand is increasing for multifamily. So we've got this weird thing going on, right? So there's no new starts, so prices should be escalating. There's market data saying that the 2024 was the bottom of the hump of a multifamily, and values are going to start increasing, and that we're at a great time to buy. But the flip side of that, and this is the insane thing, is that we've seen some pullback in rents on a national average. On a national average. Those words are very, very important. That is why we don't buy in bad areas, right? Or less predictable or less desirable areas. We want to be in markets with positive job growth, positive population growth. In those markets, we continue to see properties increase in value. But unfortunately, as a result of the interest rates, it's driving the value, the property prices down still. But in the strong markets like Florida, people aren't selling. They just believe that, that it's still gold. They're not going to move. And 2 years from now, their property is going to be worth significantly more because they're going to see a pullback by the Fed in interest rates. So there's this whole big picture going on. Multifamily is still necessary. There's a decline in inventory. No new starts. People still need housing. Rents nationally have pulled back. Single family rents nationally have pulled back. And by the way, just if you're keeping track, rents in the single family space have pulled back almost twice what they have in multifamily. It's $7 on a national average for single family, $4 on a national average for multifamily. So that's a very key number. Again, telling us that we are in the right segment of this business. I'm sorry, I could talk about this for hours because it's such a tumultuous situation right now. But again, if you're in the right market, doing the right thing with the right due diligence, I believe that it's going to be gold. The assets that you strike on today are going to be gold 5 years from now.
Same thoughts here. And this article, like Chris is citing a lot of different stats. There's 7 big data houses or associations out there that are pumping out data like this. And this article does a nice job in Multifamily Housing News of kind of recapping it. The rent decline that Chris talked about, it's only literally $4, year over year, but it still is a decline on a national level. But if you look at some of the markets specifically, like Austin is the anchor. It's dragging down the delta for everywhere, the average for everybody. Austin's down by almost 6% year over year. Whereas if you look at Florida's holding its own. It's still growing in some cities it's kind of stagnant. So it really is geographic specific. So it's interesting to watch this. And
Hey,
you're so right.
If you've got a favorite market that you think we should be participating in, put it in the chat for us, will you? Something we can look at, because we've got specific markets that we're looking at. But if anybody out there has an idea, or they've got some insight into something that maybe we don't know, we'd sure love to hear from you. Please put it in the chat.
Yeah, what's your favorite market, guys? Let us know in the comments. And I'm gonna put up this, Chris. Freddie Mac, they just took their position. Freddie Mac, for anyone that doesn't know, this is like the big brother, or the little brother rather, of Fannie Mae. Government-sponsored entity, does predominantly at least 30-40% of the multifamily loans. The ones that Fannie Mae doesn't pick up, Freddie Mac picks up a big lion's share of them. And so this is one of your biggest lenders in the country. They just came out with their bullish sentiments for 2025. Chris, your take.
Oh man. So again, bullish in the multifamily space for all the reasons I cited. And this article actually goes on to quote some of the statistics I was talking about earlier. It almost seems contradictory. This article almost seems to contradict itself. But the reality is, back to national versus the right markets to be in. Freddie Mac going bullish is great. because Fannie's a little tough to get loans processed through sometimes if you need what's called waivers. She seems to be a little difficult in giving us any waivers to make things happen. Freddie, on the other hand, quick cycle, much easier to borrow from, much better terms on a lot of the loans with regards to interest only. So I'm excited that, since I'm in multifamily, we do a lot of Freddie business, that they put this out there. It definitely helps bolster our strategies and our ability to go out there and strike quickly.
So this is good news when one of the biggest lenders in the country is saying, hey, we feel good about it. That means that they're going to deploy capital. They're planning to deploy capital for it. Chris has got a very important lender meeting this afternoon with a lender that gives Chris tier 1 borrower status. They like him, they respect him. They're physically driving to his office to go meet him because he's a player in the space. I got to have a chance to have a conversation with another lender in Lexington this morning, Lexington, Kentucky, where we've got a lot of assets, and they're excited about giving us renovation and improvement loans. So if we buy any assets that need some things like capital expenditure wise improvements, they want to give money for that between 5 and 6% interest, which is very favorable. So there are lenders that are stepping up saying, hey, we're positive about this market. We feel good about it. We want to put money on the street. And that's a good sign for us overall.
Can I speak to that real quick?
Please.
Understand that some of the things that Nate said just now are a very important part of the conversation. We get these rates that Nate just talked about because of our performance history, because of who we are, because of what our reputations are, and because we continue to deliver on the assets that we manage and the assets that we hold. And this is not stuff like, it's not likely for you to go out and get a 5 or 6% interest rate remodeling loan or in Lexington, Kentucky. It's not likely for you to go and get a 6% Freddie or Fannie loan right out of the gate. So reputation is huge in this space, and fortunately for us, we've been blessed to always do the next right thing and have reaped the rewards of that.
Chris, I admire you for helping us lead the team in that frontier. So if everybody out there only knew the behind the scenes stuff that has to happen to maintain that kind of status, they would say the same thing. So
they'll pull their hair out. Oh wait.
You're missing a couple, man.
Yeah.
So next, this is multifamily special servicing rates. Yeah. This is an indicator from TREP's CMBS loans. Chris, maybe you want to make English out of what CMBS loans are before we talk about what special servicing is.
There are special in-house loans that agencies utilize to deliver special products to special customers. There's a whole lot of special going on there, but it's a more flexible lending in maybe what some might consider a higher risk space. So a CMBS product gives you a little more flexibility with the finances and cash flow and yada, yada, yada. But most of that stuff is serviced in-house by the agencies.
Cool. So it's another source for multifamily developers or operators to get loans from. Fannie Mae's the biggest, Freddie Mac's second biggest, CMBS is next. And their special servicing rates are climbing right now. What does it mean that special servicing rates are climbing?
Well, what it means is that traditional lending is drying up. And so you've got to get these special quote unquote loans with what I was talking about earlier with exceptions and waivers and stuff like that. That market is starting to get saturated and dried up. So it's driving rates through the roof in those special markets, because traditional institutional lending doesn't want to lend to development, right? So a lot of that is affecting that stuff. So they have to get special servicing on these loans so that they can continue to operate, and you see what happens, supply and demand.
Cool. So I'm going to dig into the next report from TREP. This is the same data supplier, and this is the same kind of loan that Chris is describing. And I want to show what's happening with some of the delinquency rates. So this orange line right here is multifamily. The green line is all property types, commercial specifically. And you can see that the green line was on a steady increase of defaults for the last year. It's been on a track record pretty straight up. Multifamily didn't really start climbing until about the middle of last year. And now we're coming up. We're not as high as some of the other commercial asset classes like office. Office naturally has gone through a massive haircut because of the shift of remote work and office space not being needed as much anymore. But multifamily was holding strong. And now we're starting to see some of those bad loans, probably a lot of these CMBS loans, they're starting to work through the system. It's not massive. This is tiny. It's a blip on the radar overall, about 4.5%, but it's still, there's a little bit of change to it. Chris, any thoughts on why we're starting to see some of these loans go through defaults?
I know exactly why. And I'm going to be very blunt. Terrible operators, right? So it's real easy to operate in a market where it's totally favorable to you. Interest rates are 2%. You can get by with low return on your investment. You can get by with more vacancies in your properties because you don't have that monster to feed. But what happens when those 2.5% loans that were teaser rate now converted, and now you're paying 11 and 12% of those loans because you took a variable rate loan, and now that 2% is now 11%, and your property is not cash flowing because you're not a great operator to begin with and weren't maximizing the operation of that property. So now where you were making some money before, you're upside down and negative. And I don't know about you, but I do pretty good for myself. But at the same time, I don't have a checkbook with an infinite amount of money in it. At some point, I will run out if I have to keep writing checks. And that's what's happening to these operators. So now you're starting to see these people that have come into the market thinking they were going to be big time real estate operators. They watched 3 TikTok videos, so now they're experts. They went out and bought their first property, and that's what you're seeing. And a perfect example is what Nate talked about earlier about our Memphis property. The operator literally bought a property that was operating and functioning, got these grand ideas on TikTok about how they should operate a property, turned it into a bed and breakfast, threw everybody out, and then it was cash flow negative. And then boom, the loan came due and they couldn't pay it because the property was cash flow negative. And a bank is not loaning you money on a cash flow negative property. It's just not happening. It's just not happening. There's formulas that you have that have to work in order for a bank or an institution to lend you money. And when you aren't cash flowing, those formulas aren't working. So that's why we're seeing this fallout now, stuff going into foreclosure. And I'm here to tell you, I hate to benefit from other people's, negativity, but this is a great time if you're a legitimate operator with good, stabilized properties. Lenders will want this stuff off their books, and they bring it to you. They just bring it to you.
So are you saying that we might be able to buy under the cost of what it would cost to build it?
100%. The cost of building has gone through the roof. We can get these properties. Remember, a bank, most people don't know this, but if a bank has a property on their books that says in foreclosure, this is why banks don't, or institutions don't want to foreclose. FDIC rules say if that's a $10 million property and loan and you've just foreclosed on it, you have to keep $20 million liquid and tied up. Can't do anything with it until you get that property off your books. So you can see how it would be advantageous for a bank that took this property back. It was a $15 million sale, $10 million loan, and then sell it to us for $8 million and write off that $2 million loss so that they can free up that $20 million in capital for them to reinvest and make money on. So yes, that will drive, if you have the right relationships, it'll drive the price down, and it will be so much cheaper than building new. And let's also remember, when you build new, you borrow money today and you don't get a return until that property's done and you've got tenants moving in.
Yeah, we didn't segment on this opportunity zone, but I think next week we'll dig into this. Now that the 25% tariff is a real thing, anyone that's building right now, it's going to be a tumultuous ride. What I mean by that is that whatever cost people planned, especially since most of our lumber right now is being imported through Canada and a lot of our steel is, whatever planned cost you had, that plan's now out the window, because what your import rates are going to be much higher. Your costs are going to go up. So building new construction right now is going to have a lot of risk added to it.
I'm glad you touched on that, because people don't realize how much of our construction materials come from international. Did you know we get 70% of our drywall from China? People don't realize that. It comes across in ships, and that's what we build with. Lumber, steel, all of that stuff.
Yeah, we'll stick to buying the discounted existing properties during this phase of the cycle. It's
With
more advantageous and safer.
predictable futures.
Yes, yes. Speaking of predictable futures, Chris, we have a little open house going on here
Yes,
where
sir.
we get to we're going to pair up our investors with deal makers. If you'd like to come in person and connect with us at the office and see what we're doing, we're going to unveil what we're doing right now that's giving us the edge. In the office, you want to see our investment strategy and our thesis of what's getting these hidden off-market gems that nobody else is able to find, then come to the office next week on the 19th. This is an exclusive investor open house. Chris, what's going on? Why would somebody want to come to this?
I don't know about you folks, but when I do business, I like to look a man in the eye. I like to shake his hand. I like to pick up on the energy and feel of who that person is, first and foremost. Second, you get to come and see the fish in their own aquarium and their natural habitat. Come in and see what we're doing, see what we have going on here, shake hands, get to know us, spend some time with us. Because one of the biggest differences between us and other syndicators out there is the purpose behind what we do. And you can come discover that, come hear about what we're doing over the next year, what our plans are, and why we're different. And one of the biggest things that we're different, that makes us different, is our tagline, Believe in More. And what that means for us is positively affecting the world in all kinds of altruistic things. So come hang out, grab a cup of coffee, grab a little cocktail. We got some hors d'oeuvres coming. We got a good time for people to hang out and get to know each other. I do business with people I like. I get to know people, and that's how I get to like them.
I've verbally heard that the RSVP is already to 29.
That is correct.
There's and we don't have infinite seats. So if you do want to come, please do RSVP. Use the link. If somebody could put that in the chat for me, I'd appreciate it. If you're following us online, then go to homeinvest.com/open house, or just type in the comment section open house, and our team will private message you with the link open house. So that's for the 19th, next week, Wednesday. We hope to see you there. Just RSVP so that we know you're coming. Chris, anything else that you want to hit today, sir?
Listen, I'm going to say this. I say this almost every time. Don't let tomorrow be a repeat of today if you want a different future. If you want your future to look different, if you don't want to be slaving until you're 75 years old, start putting your capital, whatever that little nest egg is, to work for you. One of my favorite books of all time is called The Richest Man in Babylon. And it basically talks about have your money create children, and then have those children create children, and then have your grandchildren, the grandchildren of your money, be making money for you. And then when you're at that point in life, it's amazing how much less stress you have in your life, how much easier things are, because that part is taken care of. Now you can follow the passions of your heart and do the things that are important to you. But again, nothing changes if nothing changes. So don't repeat tomorrow what you're doing today and expect a different future.
Beautiful. Well said. Hey, we appreciate you guys, partners, investors, folks that are just checking us out. We appreciate having you. We look forward to serving you sometime here in the near future. Thanks, and be blessed this week. Bye, guys.
Bye. Thank you.